My name is Alex Mylan, and I'm on a mission to build my first ground-up project this year. And to do that, I'm getting advice from investors, property owners, and developers from around the world. Here today, I am so extremely honored to start with Clay Dickinson. Dr. Clay Dickinson, yes, you heard that right, doctor. He's going to be our first guest for this podcast. Clay has over 40 years of experience under his belt in international hospitality and commercial real estate. He is the managing director of Horwath HTL, and he's a full-time professor at Florida International University in the School of Hospitality and College of Business. He's one of the best there is. Speaking from experience, he was my professor last year and he was amazing. Fun fact, he is also multilingual in Spanish, English, and Portuguese. So, to start, I want to ask you, Clay, who is Clay Dickinson beyond business?
Okay, well, I think the guiding light of me since I was like 14 years old was an orientation toward doing international work. I didn't start out knowing that I was going to be in the hospitality or real estate business. My father was too cheap to take my mother anywhere. She was very cultural, loved art, loved travel and things. So we had exchange students stay in our house instead. And I got to be very friendly with this one guy who came and stayed at our house for a year from Brazil. And he invited me to go to Brazil when I was 14 years old. And that, for me, that was a game changer. It just opened my eyes. I was from a small town in Central Florida, and I saw, wow, the world is a big place. And I determined at that point, I want to have an international career. So I went to the School of International Service at American University in Washington, D.C., and fortunately was disabused of the notion that I had to be a diplomat in order to have an international career. And so I subsequently, I came back, worked for 3 years, then went to graduate school at the American Graduate School of International Management, sometimes better known as Thunderbird. And I did a joint degree program there, spent a year at Thunderbird, and then I went over to Barcelona, Spain, and did a year at ESADE and graduated with a double master's in international management and finance. And so from then I had to get, I got to get a job. And had some very interesting offers from places like the CIA, but I was young and idealistic and didn't necessarily want to work for an oil company or a chemical company or the CIA or even telecommunications companies when I figured out that war is as much about telecommunications as it is about bullets and bombs. And so I had a buddy that worked with this consulting firm called Laventhal and Horwath. They were probably the preeminent consulting firm now. Yes, that's the same Horwath that I'm now a managing director of. And they had a position down in Miami. I figured, okay, Miami, Spanish, Portuguese, my area of the world. And that's how I first got into it. I was in the commercial real estate side though, not the hospitality side. And after about 2.5 years of working in the commercial real estate side, while I'm going to Boynton Beach and Boca Raton, all the hospitality consultants are going to Barbados and the Bahamas. So I was like, how do I get over on that side? And so that's sort of what I put my hand up. And they needed someone who spoke Spanish, and so I did a project down in Puerto Rico. Really wanted to try to impress them, but I was a quick learner. And so that led to, hey, you want to do another one? We got one in Costa Rica. So then I did another project down in Costa Rica, and they were like, hey, you want to join our team? And so it was in like 1986 that I made the move over to the hospitality side of consulting, and that's where I spent basically the next 40 years.
Wow, that's so you've had a career across JLL, KPMG, IHG. What originally pulled you into real estate, and what keeps you excited through that?
Well, what pulled me into real estate was what I had sort of mentioned before, was I didn't really know anything about real estate, but it was the vehicle through which I thought I might be able to have an international career. And that's what brought me down to Miami. Mm-hmm. It was moving over to the hospitality side of it, which kind of by nature is going to be more global, more international, that it has indeed been the vehicle through which, I've been blessed to have traveled and worked in probably 120 different countries around the world.
Oh my gosh.
And what keeps me involved, what keeps me going is I think the hospitality sector is the most interesting. an exciting part of all the different types of commercial real estate. You know, there's office, retail, industrial, etc. And the main reason why is because it is first and foremost a people business. The people that are involved in hospitality, they tend to like people, they tend to like providing service and hospitality, and yet there's very serious business behind it as well. So it's almost always the combination of those factors. It's got a very strong operations component to it while it's a real estate play at the same time. But almost by definition, the markets to a hotel are going to be outside the local market area, whereas almost every other commercial asset class, the market is local. The demand for the office space or the retail is locally generated. Almost by default, the demand for a hotel is because people are coming in from outside the market. That's why they need a place to stay. And I just always found that to be much more interesting.
Right. So you mentioned your first deal. What country was that in again? Puerto Rico?
Well, the first hospitality deal I did, was in Puerto Rico. Yeah, it's funny how time goes by and your perspective on things change. I remember it was called Las Palmas Inn.
Okay.
In Palmas del Mar, which is down in Humacao on the south coast of Puerto Rico. And I think that Las Palmas said maybe it had like 70 rooms and it was about a 3-star hotel.
Okay.
But for me, there was like, oh man, this is the height of luxury. You know? And so they were looking at repositioning Las Palmas Inn, investing a little bit of capital and trying to move it upstream. And subsequently, they ended up building another hotel out in Palmas del Mar. And so that was sort of my first taste. And, again, I was very junior. My job was just to put together the numbers, study the market, and see if we moved it from A to B, would there be demand for it and would it likely be a successful project? What the developer did with it after that, I didn't necessarily know. As you move up, you become more involved in following the project through. But at that point, it was just like, hey, you do the analysis and leave the communication up to the manager and the partner of the firm.
So how do you study the market in that? Is it more like surveys or just conducting marketing research off of like the comps?
Well, back in those days, they didn't have STR. They didn't have all the third-party data sources that we do now. So it was really, again, there was two elements to this. One, we had to really tour the hotel itself in order to say, okay, what's the room size? What's the room mix? What are the common areas? How good is construction? Its location? Does it lend itself to repositioning from a physical standpoint? And then talking very much with the owner, the general manager, the director of sales and marketing, the management team, to try to figure out, would they be the right management team in a repositioned property? And then lastly, you have to identify, okay, this is who our competitors are now. And this is who our competitors likely will be if it's repositioned. And you used to have to go and through hook or crook, talk to the general manager, talk to the director of sales and marketing, and interview them and ask them, where do you get your demand from? What is the segmentation? How much of it is tourists? How much of it is business? How much of it is group? And you do that with all the different competitors that you've put forth. So you have a good idea of what the market composition is today and what it has been for the last couple of years. And then you focus on the demand side, which then goes, okay, I know that they get X amount from tour wholesalers, X amount from incentive travel, X amount from commercial travel. And you then begin to identify which are the companies, the whole tour operators that are sending business down, what are the companies that are generating demand locally for that particular property. And you had to go and interview those companies. In corporations, you would interview like the executive assistant at the office of Chase Manhattan Bank, who would be responsible for booking people coming down to Puerto Rico to have meetings and stuff. Well, where do you put them? Well, we put them in these hotels. How much in this one? So it really was very much a talking to all of the different segments, the people that were responsible for generating demand in those segments, and then building up your occupancy from that level. How much did you do last year? How much are you going to do this year? And how do you see it growing in the future? Do you see the next couple of years? Is it 0 to 5% growth, 5 to 10% growth? And then, and you'd be asking a lot of different people, so you end up sort of vectoring in on what appears to be a good illustration of what the future would look like, knowing that you're never going to, if it's one thing I've learned in doing market demand studies and putting together financial projections and building models, you're never going to be right. It's just try to be as least wrong as you possibly can be. But no one can foresee the future. And so that's why you have like sensitivity analysis. Well, what happens if it goes down 10%? What happens if it goes up 10%? And does the market, does the deal still pencil if you're off by 15%, right? Because no one can see the future. So you're just doing your best to try to predict it by doing a very good job of analyzing what has happened, what is it like now, and barring any unforeseen swan events, what can you reasonably expect the future to look like, and do it based on that.
Yeah, because there's so many things that can go wrong in a deal, right? But what's like the margin of error that you typically use for just vacancy rates?
In a hotel, I mean, you would probably move it up or down on stabilized occupancy, move it up 5%, move it down 5%.
5%, okay.
Yeah, and then on rate, move it up 15%, move it down 15%, which would end up having a net effect on your RevPAR, which is the combination of rate and occupancy of 20% up or down.
I see. So talk about like mistakes and error. What are some of those mistakes that you made early on that a lot of people don't talk about, maybe?
I think that when you're young and you're first starting out, there's a couple of mistakes I don't think there's even such thing as a mistake. I've come to realize it's not a mistake, it's a learning opportunity that perhaps I didn't take advantage of right away. And one of them was I did not appreciate the value of actually being the low guy on the totem pole and having to do, in those days, doing the actual grunt work of having to make all of those phone calls, having to talk to all of those people, having to be the guy that went and walked the entire neighborhood and wrote down every single retail center nearby, go into the office buildings and write down every single tenant in the office buildings. At the time you want to kill yourself, but that was incredibly important to build the discipline, to really understand how the sausage is made, all of the different components that go into it. Now that we have these third-party data sources and things like that, that do a good job of telling you what happened, but they don't tell you why it happened. Okay, they'll tell you, okay, this is what performance did, but you don't know why performance did that way. You only learn that by talking to people and understanding how all of these factors interact. So number one, for young people starting out, the importance of doing the work, putting in the hours, and actually suffering through it. There's a lot to be gained from that. I had this one manager, Marilyn Het. She used to drive me nuts. But now I thank her for having put me through a lot of that grind and for a significant period of time. And then I think another thing too was a mistake, and this was, I don't know if it was just a personal thing or whether a lot of young people do this, but I always kind of made the assumption that I was the least prepared in the room. That I was not the smartest person, in the room. And even though I knew that I typically did prepare very hard for things, I assumed everybody else was doing that too and more. And I remember I had a partner when I was like a manager at KPMG who basically said, Clay, your biggest issue that's holding you back right now is you don't give yourself enough credit for the work that you have put in, the knowledge that you do have. Don't be arrogant, but also don't be shy and assume that everyone else knows so much more than you. To a certain extent, everyone is faking it in life. Everyone is doing the best they can, but in a way, even when you're 60, you're going to wonder, like, what do I really know? But when you're 21, looking at someone 60, you're like, of course they know everything. Nah, we're all bluffing to a certain extent. And so to have more faith in the work that you've put in, to know that you have just as much a right to have an opinion and to assert yourself in a meeting as not. So I think that's another mistake I've made, is not having the faith that I had actually put in the work and that I earned a seat in the room.
So you doubted yourself in the beginning. How did you overcome that doubt? Was it just from people trying to tell you that you do know enough, you do have something of value, or what kept you going? I
think it was a combination of, the one thing that has driven me my entire life, and perhaps why I got so fascinated with the international arena, was an insatiable curiosity. I'm always curious about everything. Why? I was 10 years old. My dad bought me this book. It was like, tell me why. 100 answers to the 100 questions you wanted to know. He's like, I bought you that so you'd quit asking questions, But I think that insatiable curiosity has always led me to read more about a topic, to study more about the issue, to do more due diligence on a deal than most everybody else. And so I began to learn that I was indeed one of the most well-informed in the room about this. And then as you get more experience and you start to realize that some of the projections you made, some of the predictions that you make, in fact, do turn out to be true, and that other people who you thought were smarter than you, they turned out to be wrong. So you begin to gain confidence in your ability to analyze the situation and produce good results. Always knowing, remember what I said before, that you're never going to be 100% right, but I could certainly answer any question and substantiate, well, why did you come up with this assumption? Because you can make a model say anything you want a model to say. When the rubber hits the road is when someone disagrees and say, well, why do you say that? And then you have to be able to say, good question. This is exactly what I did. This is the analysis, and this is how it produced these results. And usually they would be pretty well substantiated and difficult for someone else to attack. So you gain confidence that way.
Yeah, I remember you pushing on that idea during, presentations during school. Always being curious and always having like the real reason behind just the numbers on the board, right?
You'll find that proves to be the most important thing.
Really. So, moving on to like what investors care for. Just straight up, what do investors care when they're looking at a property? When, let's say, like I'm presenting a deal and I have numbers on the board. What is like one of the main things that they would look for to trust me?
Listen, I think, and I think it was implicit. You sent some topics we were going to be talking about, and for me to read, and I did read those. Again, preparation.
Thank you.
And one of the things you say, like, what is more important, numbers or relationships? Mm-hmm. And I think to a certain extent, both are indispensable, right? And so I think if someone were thinking about investing with you, or you were thinking about investing with someone else, obviously the numbers of the deal have to make sense. But the numbers of the deal themselves have to make sense within the context of the bigger market that you're in, and the liquidity of the market, and the diversity of that market in terms of diverse demand generators and things like that. But also is, hey, it's at the end of the day, it's people that are going to be executing whatever that deal is. So the strength of the sponsorship, the intelligence and experience and reliability of the partners with whom you're going to be investing, that is also incredibly important. At the end of the day, that's often more important, because if the numbers don't work out the way they're meant to be, then you're down to the character of yourself and the partners with whom you've chosen to deal. And so I think if you were looking to raise money to try to get people to invest in you, at being such a young person, odds are you're not going to have a lot of equity yourself, and you're going to be relying on other people trusting you to do the right thing. And so I think integrity, work ethic, ability to follow through, humility that you don't know everything at first, willingness to admit, hey, you've done your homework, this is how you honestly see things, but obviously you don't know all the answers at this point. I think, and even willing to say in the beginning, I am willing to take a lower return in order for, perhaps a bigger piece of equity through my own effort, because I'm building a reputation right now. I don't necessarily have one, but I'm trying to build it. That kind of an attitude, I think among friends and family that you're trying to raise capital for, would go a long way toward people saying, you know what, he seems like a bright young man. He seems like he's humble. And he's willing to work hard. He's willing to subordinate his returns, until the product is or the project is or isn't successful. I'll take a chance on him. You don't have much else to sell when you're 21 years old. Assume you do that once, twice, 3, 4, 5 times successfully, then you've got a track record in addition to your character. And I think those two then begin to speak when you go out and say, look, I've done it here, I've done it here, I've done it here, these are the results, and you still maintain that same integrity and sincerity, then you'll find it a lot easier. Then you'll start finding people coming to you, because people that do combine all that stuff are very rare. And that's why ultimately people that are really good at doing that, there's a lot more money waiting to be invested than there are people that are really capable of investing that money.
Because would you say that the attitude and those core values that you base yourself upon, that's something that you can't teach, but the skills that you would gain through those deals, that's something that you can teach, so that's why investors are drawn to that kind of attitude? I
believe that hits it right on the head. You know, that in essence, you either have that integrity in you, it's been raised in you, or you don't. But there are ways that I think you can be coached to present that integrity so that it does come across a little bit more. But that's definitely, something that's more nature versus nurture, whereas I think that learning the technical side of the numbers and stuff, that is something you can absolutely learn.
Right. So I want to ask about some of your deals with hotel industry or hospitality. Tell me about one of the projects that failed and why it failed. Maybe it was even in a great location. Question, why did one of your projects fail? And number two, why do some projects fail even at great locations?
Well, one of the things, I've always been in the professional services industry, so I haven't done my own project, but I've worked with countless projects that others have done. They used to, the big joke about management consultants is a consultant is someone who will ask for your watch to tell you what time it is. And there's a little bit of truth to that, right? But imagine if everyone's watch is not synchronized exactly together. They're not perfect. They each tell time a little bit differently. And, I've worked with Marriott, I've worked with Hilton, I've worked with Hyatt, I've worked with, developer A, B, and C, and all of them have certain strengths and all of them have certain weaknesses. All of them tend to be a little bit blind to their weaknesses, and they think that this is the only way to do things. But as a management consultant, I get to see what's good and done right about each one versus what's not done necessarily all that well. And so through that experience, I've learned it's just as important to learn what not to do as what to do. It's been said, learn from your mistakes, but even better, learn from other people's mistakes. Right? And see what they did wrong. And so when I look at the deals that I've worked on that have been unsuccessful, they all tend to share certain qualities. And and I think one of them is like not doing sufficient due diligence on the overall market that the project is going to be located in. I sort of mentioned that because all real estate is long-term, capital intensive. It's built for the next 40 years, not for the next 4 years. Now, if it doesn't survive the first 4 years, don't even worry about the next 40 years, right? But so that means you have to look at the strength and the liquidity and what is driving demand. Is it vibrant? Is it shrinking? Of the general market where you're doing it. So insufficient, appreciate, this market it'll evolve, it'll come around. Maybe not, right? So I think insufficient due diligence there. Another one is underestimating the cost of carrying the deal if the revenue projections don't work out as they should. Right? And so it's always kind of a tendency to see the revenues with rose-colored glasses. Oh, we're going to sell this many units in it. Right. And then to sort of be, and the same thing with regard to costs, but underestimate, well, what happens if we don't get our permit in 3 months and it takes 6 months? Time is money. What happens if the interest rates shift during the period of this time? So I think the takeaway from this is to kind of be conservative on the revenue side and be a little bit aggressive. In other words, up your costs a little bit. If not, that underestimating the cost side of the equation ends up causing a lot of first-time developers and early developers to end up either losing their project or losing control of their project because they have to bring fresh capital in that says, thanks, you kind of messed it up, we're now taking over the control of the project. So I think those are probably the two of a number of different factors that unsuccessful deals have.
So you would say,
know if I was very clear on a lot of that.
Yeah, I think you were. So that's like the biggest hidden cost in projects, like carrying the deal that people don't realize.
Yes, and especially a lot of the project I've worked on, by virtue of being in Miami, I've worked on a lot of resort-oriented projects in places like the Caribbean or Central America or Mexico. And so usually that means there's going to be more than one hotel, there's going to be a residential component, there might be a marina component, a retail component. And so it requires a lot of master infrastructure, putting in utilities and power and water management and all these type things. And people underestimate the burden of carrying those costs if the revenue assumptions don't play out. And we almost have a joke, that it's always the fourth owner that makes money in these types of projects.
Really?
Yeah, because the first one makes a little bit of money, then he loses it to the bank, and then someone buys the note from the bank, and then the second person also loses. By the time you get to the fourth owner, a lot of that infrastructure has now been put in, and the product that's been built, the equity in it's been crushed down to about 40% of cost. And so then you can actually begin to leverage the infrastructure that's been put in place, and your basis in the whatever you're buying, the hotel or whatever, is so low that you can now actually make money. But it all stems from the initial problem of underestimating and not actually planning in a better way for how do I phase that infrastructure up front, either through selling development parcels to other people to build critical mass more quickly, or to basically slow down the development schedule so that I don't end up having to put $100 million worth of infrastructure in order to get the first project up and going. So in particular there, it's an underestimation of the carrying costs if the revenue projections don't work out quite as planned.
So I know you kind of touched on this, but how do you really manage that construction risk? The construction risk of, carrying that deal, those super high costs, how do you manage that, the risk management? Well,
there's a lot of different ways to do it, and it's contingent upon the nature of the deal itself. I think, if you're talking about a long-term, multi-use, like destination resort, I think a lot of developers think that they can do it all themselves without recognizing just how expensive that is. And in any development deal, there are so many things that can go wrong because of the cost or because of the time required to do it. That would be more of a structuring issue, that if I've master planned out to say do 3 hotels and a retail component and a marina, maybe it would be better for me to sell one of those hotel projects to someone else that has an expertise in this. I've created value in the parcel that I sell, use that to cover some of the cost of infrastructure. Same thing with perhaps something else that's not your core competency, maybe the marina. In other words, sell it to other people that is their expertise. You raise that money up front, which lowers your upfront cost in developing the infrastructure, and it ends up building critical mass to make the whole project more successful than going, well, first I'm going to do a hotel. And then when I have enough money, now you've put all the infrastructure you paid for, I'm going to build one hotel, and then I'm going to try to raise the money and I'm going to build another hotel. Well, by the time you could have had 3 hotels and the marina all built working together, and now you've only got one, and it's like that hotel is not doing well because the marina is not finished and the retail's not there. Right. So it becomes sort of a negatively self-fulfilling prophecy that it all kind of collapses on itself. So that's kind of a structuring deal. If you're talking about an individual project, there's all sorts of different ways to manage the construction cost. Obviously, pick good architects, engineers, quantity surveys in order to make sure you have a very accurate picture of how much it's exactly going to cost. And then you have to pick very competent construction companies, depending on whether you want to get a separate construction manager to make sure those costs stay online. That's, to me, and of course there's different ways to do it. If you wanted to be absolutely sure, you would do a sort of a guaranteed maximum price bid, where no matter what, it's going to get done. It's going to cost you money. There's probably going to be some padding in that in order to make sure that the person who gives you that guaranteed maximum price contract is not going to lose money. He may build a little bit of padding in there, so it may end up being a little bit more expensive, but that's typically what banks are going to want you to do anyway, and then pay extra money, get a completion bond, and make sure the construction actually does get done.
I see.
Make sense?
Yeah, that makes sense. So thinking about like what happened with COVID and even the 2008 crash, how did that affect like the hotel industry and hospitality throughout this year, since you were a part of that?
Yeah, a couple things. To me, there's a silver lining in every dark cloud. And I think if you look back through the history, because the hotel industry in particular, and to a lesser degree the commercial real estate overall, has gone through, in my career, almost four major events. The biggest one, which is before you were even born, Alex, in the late 1980s to the early 1990s, there was such an oversupply of hotels and commercial real estate that the government actually had to step in, because all of these savings and loans that had made loans to these, they all had to take them back, and then they failed, and so the government ultimately had to create the Resolution Trust Corporation to take all of these bad assets, right? So, but that gave birth essentially to the equitization of real estate, where now all of a sudden banks were burned, so they weren't going to give you 95% loan to values anymore because it wasn't a tax deal. I mean, you could actually get more than 100% financing because you could sell the tax credits in advance and actually raise more money through selling tax credits than the actual deal was worth. You'd put that in and get like 100% loan. But at any rate, as all this went through, banks became more cautious. Equity came in once all these assets were written down to pennies on the dollar, bought these things for equity, put a proper amount of debt on it, and that in turn increased like the professionalization of the industry. To me, that was sort of the beginning of the true professionalization of the commercial real estate industry in the United States about 40 years ago. And then, that's when you start to get a separation between who owns the assets and who manages the assets, at least in the United States. Well, then things were going along fairly swimmingly until 9/11. That was another big hit. And of course, after that, the great financial recession, and then ultimately COVID. When you get these big shocks and crises, what was Warren Buffett's famous thing, you don't find out who's over leveraged or whatever, not do it until the tide goes out and you see who's not wearing a bathing suit, right? So when times get tough, then that's when creativity, a new surge of creativity, how are we going to handle this crisis, come to the fore. And I think that's that silver lining in every dark cloud that I see about almost every significant leap forward in the creativity of the management company, of the brands, of financial structuring. All of these things come from the adversity of a big crisis. And all of a sudden, things that, we've always done it this way. Well, they were revealed, why have you always done it that way? Why? If the customer's not complaining and we can cut out the cost of A, B, C, D, and E, why don't we do it? We can't afford to continue to do this. You quit doing it, customer doesn't complain. Next thing you know, it's no longer a standard. So I think that these are the main things that were learned from each of those crises, is a more efficient way to structure things financially, to be more prudent from the lending side, to be better on the operations side. I mean, it was kind of it was a combination of 9/11. I mean, like if you go back to the one I mentioned back in the 80s and 90s, that's kind of when all of a sudden they were all branded management companies. And then it was really a lot of the great financial recessions in 2008, 2009, where you had a big growth in independent management companies, basically doing franchises with the branded, but being much more efficient in their operations, not only in the fact that they were able to cut out a whole lot of costs and drive more money to the bottom line for the owner, but also in the flexibility of doing shorter management contracts and things like that that allow for more optionality and increase the liquidity of trading in hotel assets. And so again, that was another, it took that to sort of have that model really show through as the preferred way of doing things, which is the way we have things now. Now we're in a very interesting time, post-COVID, because you've now got like a trifurcation where you have their brands under a franchise, independent operators, and then third-party owners, and each of these may or may not have anything to do with each other. However, there's a lot of leakage in that model where, like whoever owns it, they're like, my goodness, I'm paying out, 4 or 5% of total revenues to the management company, and plus a percentage of the GOP. I'm paying out another 8-10% of total revenues to the franchise company. You start adding that up, I'm giving away 50% of my bottom line to the manager and to the franchise company. What if I buy either all of or a participation in an independent management company? Then at least that way the fees we're paying to the management company is kind of coming back to me. And then you're starting to see, and with this focus, especially among young people like yourselves, on independent hotels, and that's a reason why the soft brands of the big global brands that allow a hotel to be both independent, maintain its own character, yet benefit from the other system benefits that these brands bring. Well, in certain situations, you can outsource reservations, sales, marketing, do that kind of thing, and kind of have your own brand or an independent brand. So what are we doing? I see situations in which the way it was 50 years ago is now becoming the way it is now, where the private equity fund, they own the building, they own the management company or a portion of it, and they've got their own brands.
Wow.
So now we're right back to what Bill Marriott and Conrad Hilton did, 70 years ago.
So you don't see the trend is kind of shifting towards customers not caring as much about brands, like name brand?
That's a very good question, because I think in the advanced lodging markets of the world, I think customers are looking for more authentic and bespoke individual experiences. And so if you're going to a city like New York or DC or San Francisco or Miami, having a Marriott flag or an IHG flag on the hotel, I don't think is as important as being able to easily make your reservation, maybe get some loyalty points and everything, and more Instagrammable to say that this is called the Chesterfield or whatever the independent brand is. However, when you're traveling down the highway and it's 1 o'clock in the morning, you like looking up and saying, oh, I see my Hampton Inn, I see my Holiday Inn Express, I see my Fairfield, I see that there a brand matters, because it brings that, okay, it's going to be clean, it's going to be consistent, I know what I'm getting. And so I almost say, the more commodity the hotel, the more important the brand. The more bespoke and individual the hotel, the less important the brand, the importance of the distribution system. And that's just in the advanced markets of the world. I was having a conversation with a group of people at the Hunter Conference in Atlanta this week, where what started the brands was like back in the 50s and 60s, there was no consistency if you were a traveling salesperson or you wanted to take your family on a road trip across the United States. It was all individual mom and pop motels and hotels, and you didn't know what you were going to get. Mm-hmm. And so Kimmons Wilson's, said, hey, Holiday Inn, we'll give you the same thing no matter what you wanted. And for the longest time, the brand was the consistency offered by the brand that was the hallmark of the value of that brand. Now we fast forward to your generation, all of those things, consistency, cleanliness, etc., those are table stakes. That's like, of course we expect that. Now on top of that, we want to have a unique experience when we're in Miami versus Washington, D.C. We don't want cookie cutter experience. Of course we want clean water and clean room and internet that works and all that. That's a given. In the advanced economies of the world, when you go internationally and you look at countries in Latin America, you look at countries in Southeast Asia, India, even to a certain extent Eastern Europe, they still don't have that guaranteed consistency. And so the power of a hard brand still persists. So these global brands, God bless them, they almost have to have a schizophrenic, well, how do I do a very individuated, unique experience here, but offer total consistency in India?
Yeah.
And so they almost have to support two different business models at the same time. Not an easy challenge.
That's really interesting, because I'm seeing that recently the trend for hotels and for traveling has been to really care about the location, the place you're staying at, like the Airbnb, whatever place you're staying at, just as much as the actual experience is when you're there, right? But what's interesting about it is that we're kind of seeing like the rental industry and the condominium industry go the opposite direction, with brands like the Aston Martin, Ritz-Carlton residences, people caring more about the actual brand experience that they get. So yeah, I guess, like, do you have any thoughts on that?
Yeah, I mean, it's an interesting point you bring up, because I think that up until recently, let's say 10, 15 years ago, the developers and the development of residential, whether it's first homes or multifamily, it was much more of an individual, very fragmented kind of experience. And so you didn't necessarily know, there wasn't a lot of consistency in what you were going to get from a residential product. And so the idea of then going, kind of like the way when you're driving down the highway and you want to know kind of what it is you're going to get, then I think that was part of the impetus around branded residences. If it's a Ritz-Carlton brand or a Four Seasons brand on a residence, then you can expect a certain level of quality, you can expect a certain level of service, you know what you're going to get, and it's a message that's communicated to everyone. So again, it's taking an industry that was highly fragmented and inconsistent in what the actual end product was going to be. A luxury product did not mean the same thing in this market versus this market, or this developer versus that developer. Put a Four Seasons name on it, all of a sudden you bring an expectation of a certain level of consistency to it. And so I think that's one of the reasons why some of the brands are now looking at the possibility of branding multifamily rental apartments. So that you can bring, part of it is the experience that they've proven that they can deliver, and part of it is a certain consistent level of expectation. If this is a Hilton or a Marriott or an Accor branded multifamily building, I know where it's priced and tiered, and I can pretty much know what kind of service and product that I'm going to expect. Back to your previous point about, some of the Airbnb and, I think some of the, again, I think it was incredibly novel what they sort of put together. More from the standpoint, people have been renting apartments and things for hundreds of years, right? Mm-hmm. That's nothing new, but it was the distribution platform, the ability to do that seamlessly and quickly. And there were, obviously there was a certain vetting that Airbnb would do before they would allow a product to come on their, on their platform. But early on, I think one of the deficiencies was, well, it would look like one thing in the pictures, and then when you got there, maybe the neighborhood wasn't that great, maybe the host was not that great, and you didn't really know what you were going to get. And I think to a certain extent, one of the reasons why the brands began to sort of enter that space, Marriott with homes and villas, I can't remember, Accor with One Fine Stay, they've all kind of moved into renting those homes and villas, is once again bringing a certain level of consistency in what you're going to get, how it's going to be managed, and those kinds of things, to a market that was very, very fragmented. I think they perceived a weakness in what was on the Airbnb, the Vrbo, and all that kind of stuff. And so they've said, hey, if it's affiliated with a Marriott or with a Hyatt or whatever, it's going to be of a certain quality. So it's bringing that quality assurance to a very, very fragmented base of shared residential product. So I guess I got a little bit off track there, but I don't know if that's...
Yeah, that is a very interesting point that you bring up. That reminds me when you said that you don't really know like what you're going into if it's an Airbnb. A couple of weeks ago, went to a tree house off Airbnb and didn't even know like if there's AC or anything in it. It was a completely open tree house Airbnb, and ended up being like frogs jumping into it and stuff. So Shout out Armand and Steph, or Armand and Sean. But yeah, no, you just really never know. So Clay, question. When you ask investors and developers, one of the most important things, or the top 3 most important things about picking a property to find the best investment, they say location, location, location for those 3 things, right? So do you agree with that?
I would say 95% I agree with that. Because what I mean by location, 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 I think there's different dimensions to that. There's the actual physical location itself.
Right.
Okay. And then there's the location within a market. Back to the big thing of, put yourself in a market that's got a certain strength of fundamentals and resilience and a diversified economy that's growing and all those kinds of things, which usually then there will be liquidity associated with that as well. So if you want to sell, there'll always be someone to buy, whatever. So there's physical location, there's market location, and then to a certain extent, I don't know if the word is I'm looking for it right, but it's almost like location from the standpoint of the uniqueness of the physical property itself, such that it is either appealing to a niche in the market that others are not appealing to, so it has its own inherent demand that others are not servicing, and because of that, or because of where it is located physically, in combination with the product itself, very high barriers to entry for someone else to come and build the same mousetrap. And if someone else can come and build a mousetrap that is as good or similar in quality or whatever, that they could actually compete for demand, then probably their cost of entry are going to be higher than what yours were, and you're not all that upset about it, because they're going to have rates or rental, apartment rentals or whatever that are going to be even higher than yours, and you can just raise your prices. So those elements of location, 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 I think that's why I said 95%. I think those are absolutely true. However, I also think there is one thing that this is more in the hospitality industry, where you can create a locational advantage. I look at what like Ian Schrager, Sam Nazarian, Barry Sternlicht, some of the people that sort of brought that whole lifestyle, Bill Kempton, that whole lifestyle boutique element to the lodging industry, which has now set the stage where it's the experience, that the buzz that the property generates is a lot of what attracts people. The ability to create that sense of place, that place that people want to go to and be seen at, actually allowed them to take a property that was perhaps not in an A+ location. Maybe it was just a couple blocks off. Maybe it wasn't a brand new, maybe it was an older building, but it had good bones, and so you could buy it at a cheaper price. But then by injecting that special sauce that through their food and beverage, through their place making, they were actually able to have a lower cost basis in their investment. And you would see these people leaving the same old hotels that might be in great locations, but all leaving to go drink and be seen at their hotel. Right. You see what I mean? So they didn't have location, location, location. What they had was fundamentally good bones, a little bit of an off location, but the ability to create a place that people would go out of their way to go to. And, and I don't want to, belittle any brand, but there were sort of certain brands had reputations for being very predictable, but kind of boring. And people would be there on business or whatever. And, at night when they came back from their work or whatever, the bars and restaurants in these hotels would be empty because everyone's going over to hang out at the whiskey bar, or to hang out at the SLS. And so I think that's the 5% where if you've got the right execution and the right placemaking, you can actually have a little bit of an inferior location and still make it work.
But sometimes you see like that experience actually making the location.
Yeah,
right.
It turns that into location. And there have been a couple, there was one a hotel brand, it's gone through its troubles or whatever, but Selena, which was kind of a hostile brand and whatnot, where, they could actually They knew how to read a market where like, this is the next place where young people want to go surfing. They're going to want to be digital nomads. And then they end up attracting, and this is where then the Leonardo DiCaprios kind of go and hang out there. And they take these places that had fundamentally, great beach, great waves, great vibe, kind of a magic city in Mexico or Brazil or whatever. And they end up creating a destination there. And then they end up increasing the value of all the real estate around it. So all of a sudden that becomes a great location. Right. Think Todos Santos in Southern California as an example, or some of the Saluita in off of on the Pacific coast of Mexico, Tulum to a certain extent.
Really?
So yeah. Anyway.
Yeah. So you've given a lot of knowledge and good experience. I kind of want to shift it more to like your advice, because I feel like you can have a lot of good advice to give. I'm very passionate about teaching people how to buy their first house. So I was wondering, what advice do you have for someone starting out? Let's say they have less than $100,000. Let's say they have $50,000 saved up. How can they break into that market? Let's say they're in their 20s in Miami. Any advice to buy your first house?
Well, I would have to ask you, what is the purpose of buying this house? Is it this is where you want to live, or you're making an investment?
I would say for this person, it would be both. So you'd be living in part of it and then renting out the other parts. Okay.
So because to me, one of the fundamental differences between residential real estate and commercial real estate is 9 times out of 10, your residential purchase, it's going to be more of an emotional purchase. This is where you're going to live. This is where you're going to raise your family. Often the female has a very strong voice in the actual purchase decision, but it's not necessarily an investment decision. And if it's going to be your primary residence, I honestly don't think you should base it on what's the investment potential of this. It should be, this is where I'm going to raise. If it happens to appreciate in value, so be it. I mean, obviously I think it's better to be the mediocre property in a good neighborhood than the best property in a bad neighborhood.
Right.
Okay? So don't overpay, this is the nicest house in a neighborhood that, we hope it comes around or whatever. But if you're looking more as, I'm a young person and I'd like to try to build a little bit of capital by investing in real estate, and therefore I want to buy I think that's an excellent place for young people to start. Not easy though. Where instead of, saying I'm going to spend the next 2 years shelling out $2,000 a month paying rent, maybe I will economize, try to build as much capital as I can, and buy a unit, maybe stretch a little bit, buy the unit that's got 2 bedrooms or 3 bedrooms. This might be where you rely on family and friends or whatever to say, hey, I've saved up $100,000, but the down payment required is going to be $200,000. But I'm going to rent out this room and this room. And so you effectively have your roommates paying your mortgage while the capital is appreciating.
Right.
And so, I think that thesis, you can even do the numbers on that, right? And then I think, you begin to develop the equity as that appreciates. Now, that's one thing. The other thing is try to understand the timing of the market, right? Because part of that would be, if that really works well, then either you hold it now, you've owned it for 3 years, 4 years, and let's say, for example, the timing is such that now interest rates have gone from 6%, you can now do a 4.5%. You've got more equity in the thing because the thing has really appreciated. You could refinance and go buy another one, and then this one is 100% being paid for by renters. Or you can sell this one, take the money, buy something a little bit bigger, and do the same thing. That's why you need to know where you are in the market, in the capital markets, both from where are rental rates going and what is the liquidity and the prospects of selling this if I realistically want to sell it in 3 to 4 weeks. I hope that answers your question.
Yeah, that's amazing. That was perfect. So another question. So I'm on a mission, like I said, to build my first ground up project, preferably somewhere here in Florida. I'm kind of looking at a small multifamily ground up. any advice? What's like low-hanging fruit that I could grab with a few investors? Maybe it'd be family and friends. Maybe I find a contact. Where should I start?
Well, to be candid, before I dove right into developing ground up my first product, I might put a little bit more experience underneath me of buying something, perhaps renovating it and repositioning it, get some of that actual experience of what it means to work with a contractor, to actually do the renovation work, to see if that all works out. It's complicated, but perhaps if it's not a complete gut and redo, it's not going to be as complicated as the process of actually going from the ground and building up scratch. There's a reason why, like if you look at the investment parameters, in terms of discount rates that you would apply to a development deal versus an acquisition and conversion or whatever, and the cap rates that we might apply to that because it's all going to be on the come 5 years out. There's a reason why you pay a significant discount if you're doing a development deal. And it's just because of all the things that can go wrong in a development deal. And again, that's a generalization. I don't want to crush your dreams, but between making sure you get the right land at the right price, get everything entitled, put together all the plans, and actually build the development. I don't know how many units you're talking about, but it can easily be 18 months, 2 years before you finally get all that done. And there's a lot of things that can happen.
Right.
But if you're insistent on doing that, without necessarily having, then be prepared to, as we started this conversation initially, subordinate perhaps what your returns are to make sure everyone, all your other family members, everyone who's invested, they get their returns first. You're the last guy to get paid, but you're the one who's going to do all the work, right? So, because that's kind of, I think you don't have much else to sell other than that, and having put together an interesting property. And then just, make sure you don't lie to yourself, and make sure you really do your due diligence, particularly on this. I think more important than anything is that it can come in at the costs, be conservative in how much you think it's going to cost to build it, and then make sure you're in an area that you will actually have tenants that are going to come in and rent those units. Now, I don't know, because this is not necessarily the area that I focus in, but I'm led to believe, there has been, the two big areas post-COVID that experienced huge increases in demand and huge increases in construction were industrial and multifamily apartments. And so I don't know, but I wonder a scenario in which, imagine if interest rates were actually to come down, say 200 basis points over the next couple of years, bringing your long-term mortgage rates down to 4.5%, 5%. I could see a scenario in which a lot of people that are in rental apartments thought they would be there 3 years, 2 years before they could, get their home, and they've been now there 7 years, and they are dying to be in the position where they can actually afford to move into their own home, and now they can. And no one has been building single-family homes because the interest rates haven't supported. So there's an undersupply of single-family homes, a bit of an oversupply of rental apartments, and now you got a bunch of people buying up those homes. I could see a situation in where vacancy rates in rental apartments could be elevated and make it a little bit tough for new product to come in and get the same kind of rents that they're used to getting.
Yeah.
I don't know if you understand where my mind is going there.
Yeah, I haven't thought about that before. That's a good point. So my real estate journey started 2 years ago when I was 19. I bought my first property in Pennsylvania. So through that, there was a lot of renovations that I didn't expect from it. I thought it was ready to move in, but some things that I had to manage, some projects and everything. And then from that, I was the director of acquisitions at an investment firm where I did fix and flips. So I was able to kind of like manage the contracting side of that and the acquisitions, kind of just see like the entire process of a fix and flip. So my question is, should I start with my own business, the first project I do with my personal brand, should that be another fix and flip, something that I know I'm good at? Or should I dive into ground up, maybe a single family, just one home, or a small multifamily?
It's hard to answer that right off. Let me ask you a question. In the experience you had, your own personal experience with buying a home in Pennsylvania, fixing it up and realizing some things can go wrong in renovation and whatnot, and the experience you had of the couple of years of doing acquisitions in the process of doing fix and flips, what do you think are the major weaknesses or trouble with fix and flip that perhaps could be mitigated by building your own or either multifamily or single family home?
That's a very good question. I think probably one of the biggest weaknesses is the structure of it. So you know exactly what you're building. When you go into a fix and flip, you don't know how the contractor built it. You don't know if there's something behind the wall that is gonna screw over a couple months even down the line, if it's gonna withstand a hurricane even. So maybe that you know exactly what you're building from ground up, but besides that, I would say that fix and flips are probably a little more safer.
Okay, so how about for the demand side? I can certainly appreciate that you don't really know what you're going to get into until you tear the wall open and go, oh my gosh, there's a lot of things here we didn't necessarily see. But what about from a demand perspective? I mean, like, have there been people buying or renting these fix and flips that if situations were different and they had another option that they would prefer to go with something other than a fix and flip?
That for sure, yeah.
Okay,
they would want a ground up, or they would want a new construction, yeah.
Right. So, to me, imagine the scenario in which demand in general for rental accommodations is a little bit weaker than it has been, because I think it's been artificially strengthened by virtue of the fact that buying your own house has been unaffordable for the last 3 years, 4 years. And therefore, there's a lot of people renting that, given their druthers, would rather be doing something else. Either owning their own home or renting a place that they don't feel that they're compromising on renting on.
Right.
Because they're getting a good price, but I'd really rather live in a nice apartment, whatever. And if it still works with that in mind, that, by building my own ground up development, I know what my costs are going to be. It's not a guess. And I am very confident that the market would prefer to rent this kind of a product, even if it's at a little bit lower price than what we've been used to over the last few years. It still pencils out. Mm-hmm. Then I think you've got the makings of something that's very worthwhile, right?
Yeah.
Because you can build to modern tastes, and most importantly, perhaps, is you have a much better idea of what your costs are going to be than if you're trying to buy something and renovate it.
Yeah, that's really helpful. Thank you.
Yeah.
Different kind of question. So you're such a generous person with your time. You're an advisor at RISA, right? This is more recent. Super excited about that. How has working with students shaped your perspective on the next generation?
Okay. This is an interesting question, and you should probably figure out by now I'm fairly blunt and to the point.
Yeah.
I look sometimes, I have now like a front row seat of the youth of America, the next generation. And sometimes I get despondent about that, but sometimes I get really encouraged by that. I believe that, sometimes the whole generation appears to have like acute attention deficit disorder just because of the machines and no one can pay attention for any length of time.
Yeah.
And there's a certain expectation that I shouldn't have to put in the work, and I worry about AI is exacerbating that. Well, I don't really have to do any work myself. I'll just let AI do it. And I would recommend, just as character built, the things I started out with, right? When you said, what did I learn early on? One of it was the benefit of actually doing the hard work. Maybe AI does take things, and make it easier or whatever. You will never be hurt by having put in the hard work. Trust me, I promise you. There's been technological innovation that have made jobs obsolete throughout. One thing that is a truism, the people that tend to come out on top and adapt even to a new situation are the ones that are willing to put in the hard work in the first place. Right. And so I see sometimes, well, there's a laziness, don't really want to do that. But I think that, sometimes it's not the young generation's fault that they act that way. It's actually their parents' fault, like my fault. I should have instilled different things, right? Sometimes we wonder, why did this generation turn out this? We enabled that. But I don't think anything is etched in stone. And I believe there's a couple of examples. One of them I think is, and again, I don't know whether this is politically incorrect. You can edit it out if you want. But the situation in Israel, when they were attacked in October, there were a lot of older folks around that were like, we're screwed. This TikTok earring-wearing generation is not going to be up to the task. We're screwed. And yet, what happened? You give these young people a crisis, they have been excellent. They have risen to the bar. They have more than performed. They have proven that they are every bit as tenacious and creative as their great-grandfathers were in the greatest generation. And so I think every human being has it within them to be that. And so I think that it may take a serious wake-up call to wake up the youth of America, but once awoken, the greatest generation, they weren't born that way. They rose to the occasion when the challenge was put in front of their face. And so I think to the extent that you all are faced with real challenges, I don't believe that this generation is just going to cower in the corner. I think you guys, you have the intelligence and you will step up and you will do what is necessary to meet this future, full on and with a lot of success. Mm-hmm. I just want this generation, don't underestimate preparation as a necessary ingredient of that and hard work.
Yeah.
Assuming we don't have some kind of a crisis that brings the general masses of the next generation to that level of responding, then it's going to be bifurcated between those that do on their own versus those that think they can just coast. Does that make sense?
Yeah, that's really powerful.
Yeah.
I got chills. I know you're really passionate about the next generation and instilling the right values. So, that's amazing. So, to kind of close out, where can people find you? Question. And how can they work with you or invest with you if you're open to it? Okay, well, you can definitely find me at FIU. That is kind of the, at this stage of my life, that is, I appreciate your saying that because I really do care about the next generation. I don't know whether it's just me personally or whether it's something that happens to most people as you get older, but you begin to realize that part of your sense of self-worth and what you value is what you leave and what impact you have on other people. And that's why I'm at FIU. So, see Dickens at fiu.edu. I can always be reached there. And then at Horwath, again, it's C. Dickinson at horwathhtl.com. And that's more for, again, that is a professional services firm. And so, if you have particularly a hospitality project, and that goes from hotels to marinas to golf courses to branded residential, all sorts of things that hospitality is sort of the primary DNA of it. Would love to work with you if you're trying to figure out, does the project work? Is there's partners that you can find that you need to find in order to either lend on the product or project or co-invest with you? Give me a call there. Amazing. Yeah. Perfect. And Clay, last question. I like to ask everyone this more recently. So what is your North Star and what are you working towards? What's your dream? Okay, well, I think my North Star, as I mentioned, has always been curiosity and just the desire to learn as much as I can possibly learn about this crazy world and all the people in it. And so as you get older, you realize there's good and bad in everybody, and you can choose to focus on either one. You can choose to focus on what's wrong, or you can choose to focus on what's right, and try to put yourself on the side of light and what's right, and try to be an example of that. It brings personal happiness, but then also I hope that
it can help, as I said, the next generation, to help try to bring along the next generation. My days of my professional success are largely behind me. And, what I would hope now, my North Star would be, I had to recalibrate my definition of success. Like I went through a little bit of a mental crisis, when I first retired. Like, the phone's not ringing anymore. No one's calling me for big, important decisions. At least in my mind, they were big and important. And I was kind of like, well, am I invisible? Do I exist? But now it's like one student at a time. And I've been blessed now on several occasions to have gotten letters from students that, hey, Professor Dickinson, I just want to let you know that I got this great job and I'm on my way, and it was because something you taught me, and I said it in an interview, and I just wanted to thank you very much. And that means a lot, because then I hope I've helped launch that person's life, hopefully their entire family and everyone that they touch. And so that's my North Star now, to hopefully leave a legacy that, when it's over for me, there'd be a lot of people thinking, this guy didn't do too bad.
Yeah, that's very powerful.
Yeah.
Not only are you like one of the smartest people I know, but I see you as a mentor figure. So I really appreciate that. You're so generous with your time, like I mentioned. But yeah, there's so much value in this episode. I really, really appreciate your time. First guest went very well. So thank you.
Well, thank you for asking me. And I think the fact that you asked me to do this hopefully is testament to the fact that I am having some impact.
Yeah, 100%. You very much have. So if you got value from this episode, make sure to follow. There's going to be one every week with a new guest. Thank you, guys.
Thank you.